Welcome to the Broken Pie Chart Podcast, episode number 35. I'm your host, Derek Moore, and today we have a special guest. Well, Jay, it's always special to have you, but that's Jay Pestrichelli.
It feels special to be here, Derek. Thank you.
Yeah, well, the coconuts are back, and we got some...
It's pineapples now. Now I got pineapples to deal with.
You do? Okay. Well, that's... we'll save that for another episode. But anyway, if you don't know what the heck we're talking about, last episode, we realized that coconuts falling from trees may be more dangerous than shark attacks, I think is what we found out.
That's right. Statistically, that's true.
All right. So this week, big week, and I don't even know why I said that, Jay, but we're
all-time highs. That feels like a big week.
Yeah. Well, that actually dovetails into some of the discussion. And I know a lot of us get questions on, hey, the market's at an all-time high. What should I be doing right now? Is this a good time to invest? Of course, we would always say invest but be hedged. And also there's this thought about, hey, how often is the market down where you would get another opportunity? And so I thought it'd be a good time to talk about that. And then later on, we're going to play a game. I don't know if it's a game, Jay, but it's good analogy, bad analogy for what we do. And by the way, there's also the thing, pre-retiree, post-retiree, is it better to have the markets down early or late? So without further ado, Jay, I know you did some analysis, and I believe you're going on Bloomberg next week, Bloomberg TV, and maybe you can give us a preview about some of the stuff you've been working on.
Yeah, you Derek, you are getting the first cut at this, right? This is information that you're hearing first on the Broken Pie Chart podcast.
Naturally, as we'd expect.
Yes, of course, priority here. So the study was to take a look at how often is the market within 3% of all-time highs. That number can fluctuate, but just generally speaking, if you're within 3% of an all-time high, people just are generally aware of the fact that the markets are pressing against new levels. And the answer may surprise a lot of you. It is over 36% of the time the market is within 3% of an all-time high. So think about that, Derek, right? 1 out of 3 days over the last 70 years, if you took a look where you were compared to where the market, has been, you were within 3% of an all-time high. I found that number to be a little surprising. We all know markets, go up over time. That's due to things like inflation, and there's more people on the planet now than there were 50 years ago, all those types of things, and companies grow over time. But just the fact that often the market was within 3% of an all-time high was a little surprising to me. I don't know what your feeling was about that data point.
It is surprising because I feel like when the markets are all-time highs, the comments generally are, you know what, we're near all-time highs. It's getting a little toppy. But from your research, I mean, that's more than a third of the time. And I don't think people talk about it a third of the time. So it seems like more occurrences than I would have thought.
Yeah, and even this year, right? Even in 2019, and I know that we were rebounding off of the lows of December 2018, right? It felt like it took a long time to get a new high, and we got one. What was it in April? Then we pulled back in May, and then we got a new one. Some new ones here. I think we had 3 days in a row here as of July 3rd. We had 3 new all-time highs. But as you approach that all-time high, the market, you slow down a little bit too. So I think what has happened, when my reference to this year was, I think we're actually 40% of the time, 40% of the days so far, halfway through this year, we have been within 3% of an all-time high. And I can tell you, I don't think there's anybody that feels that way. Certainly, we talk a lot about it, and the way you feel shouldn't really impact the way you invest, right? Taking emotions out of it is a real important part of it. But you nailed it on the head, Derek, when you said that people hesitate to invest at all-time highs because why? We're trained and we're taught that the way to make money in the market is buy low, sell high, not buy high, sell low. And so I think that's the reaction to a lot of folks on why they decide to wait to invest. But for us, this is a very normal situation when you're, thinking about all the ranges of where the market could be versus its, historical high.
What was sort of interesting too, you went back a number of years, and I remember, the greatest bull market in history was 1982 through 1999. Cumulatively on the Dow Jones, not including dividends, it was up over 1,000%, meaning if you had 100,000, then you had a lot more money after that. And that's not even adding dividends. But There were, I was
That's
going to do
good.
math in my
That's
head.
good math. A lot more money. I like it. I like it.
Yeah, I mean that's the greatest bull run in any historical period going back, many years, right? So, but on your research, and I realize people can't see a screen as we're talking, but I think about even that 1994 through 1999, and I think what was interesting about that period is people waiting for a pullback never got it, and somebody waiting to go into the market never experienced a good chunk of that bull run.
Yeah, that's kind of the flip side of this argument, right? So it's, well, if you're 36% of the time, within 3% of an all-time high, you've got, 64% of the time that you're not at an all-time high, right? You're not within 3%. But still, that is not to say that, waiting for a 3% pullback is the thing that people use before they trigger an entry. And I think missing out on upsides is gosh, one of the worst things you could do as an investor, because markets tend to go up over time, right? Not every year is up, we know this, but over half the time the market is up, annually 14, 15% or more. And so by sitting on the sidelines, you end up causing more damage waiting for an opportunity to buy in a vehicle. And when I say a vehicle, I mean the US stock market, waiting for a vehicle to give you a better opportunity. And quite frankly, the market is up quite often, and missing out on it could be more detrimental than waiting for a particular time to pull the trigger to buy. Timing that exactly right is a very difficult thing to do, as you know.
We look at something like 2018, and I know later we'll talk a little bit about losing early versus losing late in retirement, meaning markets go down earlier, markets go down late. But 2018 was an interesting call out point for me, and that the markets retraced. I think Christmas Eve was sort of the bottom, right? And so that was a late pullback, right? So that was an odd year in that, you could have waited theoretically all the year and got in at the low, but it doesn't always work like that.
Yeah, right. If you were almost any time during 2018, if you had, waited to pull the trigger and somehow, figured that Christmas Eve was going to be the worst of it, yes, that would have been a great time to wait until. But there were plenty of times leading into that, right? October was a pretty bad month. November was flat to down, and then December was a really bad month. Just deciding when to do that is difficult. But you're right. That was one of those rare scenarios where if you had waited at any point through 2018, you could have got a pretty good price. But again, that was the low we saw. It was the first, almost 20% pullback we've seen in years, right? 5-6 years it took to have one of those happen. And so, if you've been waiting for 5 or 6 years for a 20% pullback, you still would have missed out on way too many of the gains.
Well, and take the flip side of that too, Jay. Let's say you won the lottery on January 1st. So after all of the pullbacks happened in December, and you said, you know what, I'm going to wait until the market goes down 10 or 20% before buying, you would have missed over 20% of the upside so far.
Yeah, no, that's exactly right. That is exactly right. And it's just one of those things that it's if you could invest. Now here comes the transition. Ready for it? If you could invest in a way where worrying about 20% declines was off the table, right? But you knew that you had the advantage of capturing the majority of the upside. It's hard to argue why you should wait to invest if you have a long-term horizon, right? If you're saving for your long-term retirement, 10 years, 20 years, or even college for kids that are, children that have 10 years to go, timing that. I know I'm beating up on timing. Sorry about that. I feel like a little bit of a broken record here, but waiting, it ends up costing you more than trying to find the ideal time. If let's say you won that lottery in 2014, and I don't have the numbers in front of me what the total return would be between 2014 January to say, December of 2018, you would have missed out on plenty of growth from 14, 15, 16, 17, and then, picking the bottom of 18 to buy. And you might have got it exactly right on the bottom, but you probably still are not as profitable as you would have been if you invested years and years before.
What else did you find? You ran the study, and you ran two different studies. One, how long or how many times, what percent of the time we've been within 3% of an all-time high. And then conversely, you said, what was it? The 1 year later, did we see a 10% drop? Did I get that right? Maybe talk a little about those.
Yeah. How often, on your decision day to invest, if you had waited, would you have gotten a chance to purchase at a 10% discount? Right? Not even a 20, right? Let's just say 10%. Usually 10% seems to be the number a lot of folks say, well, when it pulls back 10%, I'm happy to get in. And so the study was, if, and on any given day, if you waited 1 year from now, would you get a chance to buy in 10% cheaper? And the answer is it's 30%. So it's less than a third of the time do you even get that opportunity to buy in at a 10% discount, which means you end up spending a lot of years waiting for your opportunity to buy in at that 10% discount.
2017 was an interesting year too, and maybe we could talk about that a little bit. That one, I think, was that the one that was within 3% of an all-time high most of the year, but we never really had any. I mean, volatility had the EKG of a rock that year.
Yeah. So 2017, 100% of the days in 2017, the market, not including dividends, I guess it's even better, right? 100% of the time, the market was in 3% of an all-time high in the year 2017. It was an anomaly, in our history of the last 70 years on this study, that hadn't happened before. There were some years that it was in the 90s, but never 100% of the time. And then the flip side of that is how often in 2017 would you have had a chance if you waited 1 year to get, to buy at a 10% discount? It was only the last couple of days in December of 2017 that would have mattered, because you end up capturing the decline of 2018 at the end of it. But almost, very few opportunities to buy at a 10% discount on any given day in 2017. So it really was an interesting year from the fact of, if anything is going to make the case about why you should, when you're ready to invest, you should invest, it's 2017 certainly makes that case.
I think the other thought process too, for me, hearing that 36% of the time markets are within a 3% or within 3% of an all-time high, is you've got this thing where it's like, hey, if I'm waiting, markets make a new high after they've made a new high. And if I wait 36% of the time, I will potentially miss out on something. Like it seems like a lot of time historically that people might not have invested, but every new high is preceded by a new high.
Yeah, well, that's true. So if we were to talk to someone who believes in technical analysis and is a technician of the markets, they would tell you that momentum is certainly something that continues. We've always heard the phrase, the trend is your friend. Well, guess what the trend is right now, right? And it's up, certainly when you hit all-time highs. There's lots of reasons why markets value themselves where they do. And this, I'm not even saying from a fundamental, just from a technical standpoint, price and volume action will tell you that, when the market's pushing higher, it typically continues to do so. Oh, that is not a bullish recommendation, by the way, even though we are bullish because we're hedged. So we can afford to be. But I wasn't taking a position directly saying the market's going up, on Monday, Tuesday, or Wednesday next week.
Yeah, no. And as a technician, as you are, but as a market technician myself, it is interesting, when people say, hey, do you think the next move is higher, lower, or sideways? I say, well, it's one of the three. But here's what's interesting. If you look at longer term charts, we are at highs, and it seems crazy to look at almost a 3,000 handle on the S&P 500. And by the way, it was crazy when we saw 1,000 the first time on the S&P 500. So it's just a number. But I always say, we could be at a triple or a quadruple top, and it's only a top if it bounces and goes lower. If it breaks through, then guess what? But to your point, Jay, it's not about trying to time the market, and it's also trying to take away the need or the perceived need to be perfect on your entry, because we know that 36% of the time the market's within 3% of an all-time high. We also know that sometimes you get a chance for a pullback, but the reality is you might have missed on long-term, bull markets by sitting and waiting. And I think, Jay, it goes to the point of, one of the core strategies we use is the idea of buying the market, getting the majority of the upside, but then limiting the downside to something like, around 8%, maybe 10%, or you have that floor. And most people aren't afraid of an 8% drop. Let's just be honest. Most people are afraid of something much, much more catastrophic. And that's what the pain point is.
Yep, I totally agree with you, and it's there's two reasons for that 8% number, right? By the way, statistically, we picked that number because 1 out of 5 calendar years the market is down 8% or more, and so we think providing value and a hedge and protection at that frequency makes sense. And then the other reason is, like you said, a moderate investor should be able to withstand an 8% level of fluctuation within their portfolio in a 12-month period. So, those there it's deliberate. We could have hedged at 15, we could have hedged at 20% down. But we thought, in order to provide the best benefit for, long-term growth, it's avoid 1/5 of those bad years and capture a substantial amount of the upside on those good years. And the strategy is, like you said, is designed to capture, take advantage of the fact that the markets continue to press to new highs over time. We like to say, we estimate that we capture 70% of the upside, sometimes 75, sometimes 65, but generally speaking, 70% of the upside of the market. And that is much better when you're building a plan that has to do with growth, right? And that's a long-term plan. And so, I'll pivot back to you on this one after I say this one last thing. If your plan requires you to make, say, more than 10% a year, then that's a pretty aggressive plan, right? It's difficult to do that on a sustained basis without enduring a lot of volatility. But when you can, take out those bad years from the equation through a strategy that uses options to hedge, and give yourself the ability to capture the majority of the upside of a market that is generally up, it's a much better way to achieve your goals.
I think one of the things that's really key with what you said is the generally up. And we know that historically over time, markets have gone up. We know that there's been periods that have not been great. If you invested in March of 2000 at the very high, and then 10 years later, you would have experienced a couple down years early on. You would have experienced the 2008. I do think it's interesting, though. There was this belief in the markets. About the random walk theory, right, Jay? That's
I do.
yeah. And I heard somebody. By the way, they described it. They said if somebody was in a bar, I thought he did a good job of explaining this. He said, look, if somebody comes out of a bar and maybe they've been in the bar a little too long, and you know what that means. So they, I'm not saying you, Jay. I'm just saying people.
Well, I was like, geez, man, I'm just sitting here on the mic. I don't.
But the whole point is, if the random walk says somebody comes out and they're leaning up against a lamppost, and what's the most likely place that they'll be 20 minutes later, a year later, 5 years later? And by the way, the bar's closed, so they can't be back inside. Generally, they're probably going to be right around that. And they would come up, it's sort of this random walk theory. And what's fascinating about what your statement is, markets generally go up over time. It's that they do go up over time. And the problem with sort of prices are random is that if you were to run a random calculation in Excel, just do a random number generated, and you wanted to overlay that against the historical markets, you have to put an upside bias in it, because otherwise, if the markets didn't go to zero over 100 years. So prices aren't random, in my opinion. And we do have trends. We have long-term powerful trends in the market. And it's this whole idea. I mean, if somebody is wanting to save for retirement or in retirement, like, you need growth. And stocks over the long run have provided that growth. The protection area, I think, is key, though. Anyway, I came, sometimes, something comes to me, and maybe that was good, maybe it wasn't, Jay.
No, so I'm glad you brought it up, right? And you touched on the concept of probabilities and where something will be over time, right? And we know, generally speaking, things that the greatest chance of where they're going to be is where they are now. But to your point about having this upside bias over time, you do have large demographic factors that push markets higher over time. That's the point of them. And while any asset class can provide that, it's difficult to find alternatives these days that are going to provide it with a regularity or a risk managed ability to deliver on growth. And so there's two things I said there, right? You got this regularity of stocks, which, are things like, why you choose stocks over things like Bitcoin and cryptos, or even oil and currency. You like that? I went to Bitcoin on your podcast. And I know. Or the second thing is with the size that can help you achieve your growth targets. It's predictable, to a degree of where a bond will be when it matures, especially a treasury, right? That's pretty predictable. But what you sacrifice for that predictability is return, and these days especially. And so, I'm going to pivot it here a little bit for you, which is, while you have this random walk theory going on, you also have not a lot of other places where you can put money that would provide you growth and hit your targets.
No, I agree, and I think really the two classic cases, or let's say clientele, that a lot of people deal with is, you've got somebody who is pre-retirement, and let's say within 10 years of retirement, or maybe 10 to 15, and then you have the newly retired person, and those are really key areas. I know, Jay, that we had seen some research recently where the topic came up: let's say you retire, is it better to have the worst years early or have the worst performing years late? And I think there was one study that's, assuming they were taking withdrawals for living expenses. Investor A, who has early negative returns, I think they started with 250,000. I don't remember what the parameters were, but they were almost out of money, I think, before 80. And then the lose late, they still had, I think, plus 600 or something like that. But I think that goes to the idea, if losing early in retirement is very damaging and something that maybe people are afraid of, it really sort of goes back to the hedging aspect. Like, if you can preserve someone's wealth early in retirement, you take away a big, big risk that's out there, right?
Yeah, and one of the key things here is when your money is coming out of your account, because just general investing, it doesn't matter what order returns come in. So let's say, I'm going to give you a quick example, Derek, and I think you'll know the answer here. Let's say I'm going to have returns of 3%, followed by 4%, followed by 5%, right? The average of those 3 years is 4%, right? Add them all up together, divide by 3, 4%. So it doesn't matter if I go 3, 4, 5, or I go 5, 4, 3, or 3, 5, 4. I still will average by adding them up and dividing by 3, right? So the order of your returns, and even this, by the way, includes compounding, it doesn't matter. The order of your returns isn't important until you start having money taken out of those numbers. So, for example, if I just gave you that, that math, again, but each year you're taking out 3%, right? A 3, 4, 5 is very different than a 5, 4, 3. And because if you're taking out 3 and your first year return is 3, well, you're at 0 and you have no ability to gain no matter what the market does afterwards, right? So it has to do with linking of when money is coming out and when those returns come, and where do you have the most risk. And the most risk of you running out of money in retirement is the very first day that you retire and take money out of your accounts. And that's why you want to protect it.
Yeah, I think the other thing too with the downside protection, it goes back to the whole, you lose 50% on $1 million, now you have 500,000, you gain 50%, you have 750. Your simple average return is 0. Your geometric compounded growth rate is you lost basically negative 13.6 annualized, over 2 years.
You just do that in your head right there?
Of course, Jim. Of course. No, I had that.
I know they're numbers we throw out all the time. I'm just putting you on the spot.
Yeah, I very easily could do geometric returns in my head. Who can't, right? By the way, Excel has anyway, let's move on there. But the point is, and then to what you were saying, not only that, but if you take big losses and then you're taking money out. So this is where something like a buy and hedge strategy, where you've got that, maybe that 8% floor, you're taking money out, you've got the floor, you avoid the really, really large drawdowns. And because when you have the large drawdowns and then you're taking money out, that balance gets eroded really quickly. And you never know what the sequence of returns you're going to get. If you retired in 82 and you live 20 years until 99, that was the best period for your returns you could ever have in history. In fact, if that was your working career right before you retired, pretty darn good as well. But it's just, to me, and here's the other thing too, Jay, and this maybe is the pre-retiree, someone 10 to 15 years away. We've talked about, how many doubles do you need? The problem is going to, a 50% stock, 50% bond, or 40% stock, 60% bond. Bonds aren't giving you anything. So this also says I need more growth, but the only way to reach for that more growth is to have some safety net below.
Yep, I agree. And because of the way that the math works over time, there's two factors that help deliver superior returns when you're hedged, even if you're in pre-retirement. The first thing is avoiding those big down years. Of course, allows you to have a defensive posture when things are bad, and it's not something that has to do with market timing, but it has to do with the natural construction. It helps you avoid those big down years. Right at you always get that minus 40 or minus 30 right when you're at your peak, right? Everybody always remembers their value right before the big sell-off. Why? Because it's right before the big sell-off, of course. And that's always probably people's high. And so, when you have a 30% or 40% hit on your greatest size, on your largest portfolio size, that's going to feel the worst. And so by protecting that, you certainly can manage through, reducing the downside participation of a sell-off. The second piece is, and we rarely talk about this, Derek, and it's because we're in the middle of the largest U.S. expansion in history right now. The second piece is the fact that when you've avoided your losses, you can reinvest while the market is low and buy the market cheaper using dollars that didn't take the discount that the market provided. So in other words, if you've limited your loss to 8%, but the market's down 40, you've avoided, let's just say 32%, simple math. You could then reinvest that and have more shares as the market rebounds than you had on the way down. I know I went into we call that the hedger's opportunity, and I know we've talked about that in the past, but I thought, supporting your point was important with those two facts associated with this methodology of investing, because, even in pre-retirement, it matters to protect.
It's, as I'm thinking of that too, and I know we're going to do the good analogy, bad analogy game in a second, but I'm going to flip that around. I think hedging not only gives the opportunity to buy more shares lower, avoid the losses, but we've been talking about how people are reticent to buy stocks when you're within the all-time highs. And what's interesting too, I think that having a hedged equity strategy is almost a hedge against, it's a hedge against not buying too. And I'll explain. I mean, if you put money into the market and let's say you're going to get the majority of the upside, not all the upside, it's a hedge against, not waiting. I'm doing this on the fly, but hear me out for a second. Somebody says, I'm going to wait. Well, if they never get the pullback, they lose all that opportunity. And then maybe they wait until later. But if they put money into a hedged equity strategy, the goal is that if markets go up, you're giving up a little of the upside. But it's sort of hedging your time. Good analogy, bad analogy.
So I get the point, and I hate to vote the first one as a bad analogy, but I get your point.
Oh, all right.
So I know, boo. I listen. You're hedging against yourself. You're hedging against your decision-making process, right? You're hedging against, what if you're wrong? The best traders on Wall Street are wrong 40% of the time, and you have to ask yourself, do you think you're better than the best traders on Wall Street? And you're going to be wrong plenty of times. Derek, we're wrong on market direction calls all the time. I'm so glad people don't hire us to call the direction of the market.
Never. I don't know. I don't know what meeting you've been in, Jay, but
right.
I'm kidding.
That's right. You've never been wrong. I forgot. And so
all the time.
I get where you're going with that, right? You're hedging against time working against you, right? That the odds are going to work against you. And so I get it. I get where you're going with that. Derek, we have a lot of folks that listen to this podcast and listen to the blog at Take a Financial or watch the blog at Take a Financial.
We don't have that many, Jay, but I'll go ahead.
I know for a fact I can think of 3 of them off the top of my head that are just happy that they let us follow this methodology of regular investing and not waiting and not timing the market, because I think, everybody will be like, yeah, fine. Everybody somehow picked the bottom of Facebook apparently, but or Apple, right? Those single stocks. But when to invest in the broad markets, I don't know any of them that have reached out and said, now's the time to go long now, because it's just a hard thing to do. And so all of them, the 3 of them that I'm thinking right off the top of my head, and you know who you are, all of you guys know exactly what I'm talking about when I say you have expressly said to me, I'm glad we just had you do it. Right. And these guys all have trading experience, and they are men. I think women are probably a little more rational when it comes to investing. But all of these men who I know understand trading and trade on their own all the time in individual names and have their play money, all of them with their investing money have certainly been happy that they chose to trust what history has told them and follow this methodology of being hedged but invested.
Yeah, no, I agree. And by the way, I totally, this is the problem when you do things on the fly. What I should have said, Jay, is you're hedging your decision to wait, because if you're wrong and the market goes up, you hopefully get at least 75% of it.
All right, I like that a lot better. And you probably said
Okay.
it and I just missed it.
No, I didn't. I messed it up. All right. So we might as well go into this now, because you and I like to come up with analogies to explain. You've always said sometimes, Zega specializes in hard to explain strategies that try to provide a positive outcome for the end client. And so we like to come up with analogies, like all sorts of ones. So here's one I'm going to throw out at you. Kevin Durant, NBA star, and probably arguably, he's a 7-footer who could play point guard if he wanted to. In fact, he has at times. One of the best players goes down with an injury in the NBA Finals. If you're not familiar with the NBA and Kevin Durant, Google it. You'll find hours of highlights. So he goes down with an Achilles injury. He's going to be out a year. The Brooklyn Nets just signed him. If the Brooklyn Nets are still able to capture 75% of what he was, meaning his upside, that's still a pretty good return. And by the way, the Nets weren't going to win the championship anyway. So if they don't, what's really the downside of this? Good analogy, bad analogy for hedging, Jay.
All right. I guess I ask, who's it good for? So I'm going to say bad analogy because it's still unclear to me. And so is it good for the owner who's selling tickets? Or is it good for the fans who are waiting for, a championship?
Well, the fans aren't going to be any worse off. What else were they going to do, right? It's not an NBA podcast, but let's look at it from somebody who invests in a team and is, the downside is they probably bring in some more revenue. And their downside floor isn't quite as bad, but the upside is potentially good. All right, maybe it's not great, but we got to talk about Kevin Durant on a.
Listen, I love talking about KD, right? It's a great topic to bring up, sure.
All right, so the point is, it's not bad getting the majority of a market upside, I think is the okay. Last one, and then I think we have a couple wrap-up stuff. So somebody recently had to have some medical stuff done. And he said to me, some years, like you pay for your insurance, and let's say, you have to pay 3% of your salary. And then let's use an even number, $100,000, and it costs $3,000 a year. Insurance is probably more than that now. But anyway, let's say it's $3,000 a year. So their cost is about 3% of their salary. And their deductible is $5,000. So really, the worst case that could happen is they have medical bills that are exactly $5,000, and essentially they wind up costing themselves 8% of their salary. And the person said to me, they went beyond the deductible, so now theoretically everything's free. It's like they would rather have just, why not have $100,000 in medical costs that year? And it reminds me of what you were saying about the hedger's opportunity, because the hedger's opportunity is, hey, once the market goes down, go down 80%, because I missed 72% of it. What do you think about this one, Jay?
I love this analogy. This one's perfect, right?
Okay.
If it's going to cost you money, get the most out of it, especially if you're going to have your max out-of-pocket expense in your scenario, $3,000 for the cost, $5,000 deductible, $8,000 out of your pocket. Load up, right? Have as many procedures as you can. You want to get that special procedure done you've been waiting for, as long as it's covered in the plan, then go do it in that year, right? So you really, in those scenarios, you want the most, you want to take that worst case scenario and you really drive it down so that you're getting the most out of the money you invested. And quite frankly, I love using insurance as an analogy when it comes to hedging. There's a lot of ways to do it. I have an analogy I use all the time, and I think you hate it, but I'm going to throw it out there and let's see what you say about it. Is, when you think about the cost of hedging, let's equate to two drivers, right? If you're an insurance company and you're deciding who you want to insure, and you have an 18-year-old driver or who's just got his license and, is out there, we'll just say doing what 18-year-olds do. And then, or a 65-year-old driver who has no points and hasn't had an accident in 15 years, which one of those two are more expensive to insure? The answer is, of
Well,
course, the 18-year-old. So that for us, when I think about analogies of explaining insurance, I've liked your analogy, and I've thrown this one out at you. Let's hear what you think.
no, I think the interesting thing about your analogy, though, is that the 18-year-old who probably doesn't have as much assets unless they're one of the Kardashians is probably doesn't need insurance as much as the 65-year-old or the 50-year-old. Because, by the way, the pre-retiree, post-retiree has been at their peak working years. So the person who needs it the most are actually the ones who have the most assets. And by the way, this reminds me, Jay, of when the markets are nearing all-time highs, insurance costs the least when it's near the all-time highs. And so now should be the time that somebody is getting insurance. I like it, but I think it brings up the question of who needs the insurance the most.
Actually,
Well,
it's I'm going to say yes. You just hit that analogy perfectly, because when you think about who needs it the most, it's the one who's been the safest because they've been able to, arguably, been safer, right? They haven't banged up cars, they haven't spent money on cars, they haven't had, a lot of emergency room visits, right? I'm really taking this one far, but
mm-hmm.
you're right. The one who needs it the most is the cheaper one to insure, and the one that is more expensive to insure doesn't have that much to insure in the first place. Now, of course, the insurance analogy breaks down when you talk about death and long term manslaughter charges on an 18-year-old. But that's taking it all the way down the wrong path. But I love the fact that you brought up this concept of when the market is most optimistic and your value is the highest, it is the cheapest to hedge most of the time. I mean, it's not every time, but just about every time, when the market has the least amount of fear, it's exactly the time to buy your protection.
Jay, you've talked about the hedger's opportunity in car insurance before. Take that a step further too. When you buy car insurance, you pay premiums month after month after month, and when the value is the most, theoretically, and hopefully nobody's injured, no one at all, right? Not even a scratch. But let's say you total your car and somehow you walk away with it without a scratch. You get a new car, but you never had the hedger's opportunity. It's not like if you drive in a Mercedes, you got to get two Mercedes now. And really, theoretically, you have that opportunity with markets, if you get where I'm going.
I know exactly where you're going. The only way that would ever work would be if all cars lost value as you wrecked your car, but your car value, you lost less and you could resell it and buy, a bigger car and do an upgrade. But that's not the way it goes when it comes to insurance, right? So if everybody wrecked their car simultaneously and you ended up, but nobody else had insurance, but you did, then of course you'd be able to buy all those other cars cheaper. Now, naturally, they're all wrecked. And if they self-repaired, well, now this becomes a better analogy. So you're right. When it actually becomes to the asset you're protecting, the analogy breaks down. Maybe you don't like
Jay,
it.
Well, you bring up something, though, and that's purchasing power. So in your example, let's say you're hedged and other people aren't. You maintain most of the value of your wealth. That means your purchasing power went up.
It did. Yes. Yes, indeed.
So imagine if you had a hedge on your house in 2007, 2008, and then didn't lose as much. All of a sudden, you could take that value and then go buy a reduced value house. That's really kind of what happens when you have the hedger's opportunity.
That's exactly right. Yep. So that's a good one. Maybe with the house thing.
All right. I think people are going to get tired of us talking about analogies. Maybe. Send us emails. We like emails. So these were a couple of things. Jay, I think it's a good discussion, though, because we know that people have been asking us for our opinion. I know you're going on. I think you're doing Yahoo or The Street, or you're doing a couple of things. Bloomberg next week, and I know this will probably come up. But it's sort of topical because it's always the question, should I invest now or should I wait? And I think it's the verdict is, look, if you're hedged and you take away the worst case, then what do you have to be afraid of?
Exactly. Why would you not invest here? It's harder to time that dip. Take the momentum, take the general, historical trend of markets appreciating over time, put that to work for you, and eliminate the need to get your timing right.
Well, Jay, I think that's a good spot to end it. And we'll be back maybe in about 2 weeks, Jay. We'll do another one of these. And so if you have topic ideas that you want us to cover, reach out to Jay or I. We always love to hear from people. We've heard from a few listeners. We don't have that many listeners, but we have listeners, Jay, and they're good listeners. They're good people. So we'll leave it there. Jay, thanks again for coming on. Good luck, and we'll look forward to seeing you on Bloomberg and some of the other news stuff you're doing next week. Thanks, Jay.
Thanks, Derek.
Take care.